into overtime. Markets are closing, as it were. Your thoughts, picking up from the conversation we were just having on last call, extolling the joys of not thinking. Does this move today tell you anything about anything other than there appears to be a giant magnet above the markets and it will not be denied?
Yeah, I mean, I think it just sort of validates that when there's not a specific object of thought, the most obvious being the Fed meeting, or the most obvious being some sort of, guidance from one of the Mag 7 that's not super positive, like some sort of comment from Altman or somebody, not that he's Mag 7, but the same idea, saying where expectations are too high, et cetera, et cetera. It just validates for the 8 billionth time that absent a really meaningful focus point that is in the negative, that the market is going to go higher, and in some cases it's going to go higher substantially depending on the names. And I think it just continues to validate my thesis that looking at the non-performer of the Mag 7, which is a relative statement, but looking at the non-performer of the Mag 7 and buying it, or at least selling put spreads on it, is generally a winning idea.
It's an interesting mix here today for sectors. Technology obviously up 1.14%. That's the standout. Consumer discretionary up almost 0.9%. Consumer staples down, healthcare down a little bit, real estate down a little bit. Otherwise, a kind of quiet day, but tech probably the leader on the board. Speaking of the Mag 7, here's the Mag 7 ETF. It's not really doing the heavy lifting here in aggregate. Kind of stuck in a range going back, shock of shocks, to right around the Fed meeting. Any particular names stand out for you here as individual opportunities to that end, Dylan?
I mean, I think Amazon is interesting of all of them right now. Just from the chart, and because of my thesis that Google came out and had a giant piece of information, and the stock goes bananas. Tesla has had a moment, and I don't see how an Amazon moment is not somewhere in the next 3 months. It just because everybody's fighting the same game. You can see that Google gap. There's a Tesla gap like that. I think there's an Apple gap like that even in the last few months. There's the Tesla gap. Look at the Apple chart. I think it's the same thing. And so there you go. Same deal, I think, twice. And Amazon hasn't yet done that, at least not recently. And so I'm attracted to Amazon because it's obviously a super credible member of the group, and it hasn't teed up a big gap announcement of some kind. And so if nothing else, it's a put spread conservatively with a little bit of room on the underneath it. But as far as names are concerned, within the Mag 7, I think Amazon is the most interesting of the bunch, just because of the way that the price, the behavior of the stock price, and my thesis that there's always that they all have a big rabbit that they're waiting to pull out of their hats. It's just a matter of when it's ready to go, which kind of brings up the Tesla thing tomorrow. And now the interesting thing is, I feel like when it's these well forecast events and these big events that are coming in, they actually tend to be generally, I mean, there are a few exceptions over the years with Apple long ago, but they tend to be generally anticlimactic. It's more the less expected event where then they come out and say something hugely significant relative to a massive industrial application of the technology that just wasn't previously known. And so I just think that that's where Amazon really has everybody and presents an opportunity.
The Tesla thing is interesting to me. The stock's actually bid after the close. I hope it is something transformational, honestly. I mean, I think this is the type of environment for it. I mean, the market is generally trending higher, as we see. There really isn't a wall of worry, if you will, in the market. And so, I mean, this is what I expect markets to do when there's no wall of worry. And when there is a real wall of worry, I expect markets to actually fall. I mean, that's just kind of the way it goes. And so right now, I think this is an absolute trader's paradise, this market that we find ourselves in. There's actually things where you can short vol and sell some strangles, believe it or not, even though the VIX is basically sitting around 16 and change. And a lot of them do happen to be in this whole ecosystem with AI and energy, right? Like it's the uranium names, the quadruple U, the NEE, those type of names have implied volatilities that are kind of high right now. And the stocks look like that. So that's the hard and dangerous part, right? Like you can either decide to just sell upside, or you could sell the strangle and hit both sides and possibly get hit. We'll see. Obviously, there's a lot of vol, and many of these tech names we mentioned. AMD just sort of pierced through the vol universe today with this huge move that just happened. There's Oracle, obviously, still has a lot of implied vol to it. Micron. So there's that. You can sell vol in those if you want. And then on the boring front, there's plenty of these Dow-related names that I've noticed more recently. I can't remember if Deere is still in the Dow or not. I think it is. Deere is one of them. I feel like Costco is. These boring ass names, if you will. Look at these charts, right? You see these names. You're like, these things aren't necessarily really going anywhere. If you want to park some money in these, you can. Last I checked, we still have farming equipment that still is something that needs to be done. Costco, everybody still, well, I shouldn't say everybody, but there's a lot of people that use Costco, and they pretty much have everything you want. And so there's those type of names. They don't have to be these names that are up and to the right that we pulled up on the screen. It can be those. There's a lot of, there's so many different things you can do in the stock market right now that makes it such a trader's paradise. And then, you can try and get short, but I don't necessarily know how that's going to work in the time being. You got to give yourself some time frame.
As I look at sort of, I mean, obviously I've been looking for opportunities to get short to kind of try to nail down where the risk reward on it is, and at least looking at the indexes here, it doesn't seem like the risk reward is here. Now, I suppose you could say, okay, well, this is setting higher highs. If you look at just a basic momentum study here, in this case I have RSI, but you can pick which oscillator you like. It doesn't really matter. They all show you basically the same thing. You are getting this kind of weird divergence thing where this is setting higher highs and this is not, and that's telling you that momentum is fading, but that's not enough to go on. There's just not a reversal signal here. I mean, taking a stab at a short here, as I did on this downtick, that makes sense. Because then you go, okay, well, maybe that's a top. Let's see. And then over here somewhere, you confirm that it's not, which is where I got out with the close above these highs. So unless you get this kind of situation, this kind of a situation, this kind of a situation where there's at least a tradable something that you can look at and go, okay, maybe it's rolling over. Vol is really cheap. I could take a stab in a risk-defined way, and I'm either right or wrong, but at least the risk-reward makes sense to roll the dice and find out. But it doesn't really make sense to me here. Not in NASDAQ either. I mean, this is clearly making higher highs, not only on an intraday basis, but on a closing basis too. Same divergence, but doesn't really seem to make sense to actually try and take a stab at anything until you get some sort of a substantive thing that looks more like a turn. I mean, if you had to sort of guesstimate it, I guess you'd say, okay, here's your sort of line in the sand. If you can get under this low, where this was the break above the high, the retest, and then extension, if you can get under this low, okay, well, maybe something different's going on. But at the moment, it's just not there. Same thing with Russell, where you're a little bit soggier in the sense that you're still inside this swing high here. So if you wanted to kind of make the case that maybe what's going on here is some kind of a double top type of thing here, and said, "Oh, we'll look at the length of these wicks and all this kind of stuff." Maybe, but there's no confirmation here. There's not even a down tick against these levels. I would argue you need to end up somewhere back here again, at least somewhere sort of near this area. Let's call it 2460, 2470, somewhere here. And then maybe you've got something. But there's just not an attractive short here as far as sort of the market as a whole. Individual names, I don't think there's, in this kind of an environment, any individual names I'd want to short either. I mean, if I was gonna go shopping in this kind of environment, it wouldn't be for shorts, because, to your point, this seems like the kind of to both of your of your points. This seems like the kind of environment where the market just isn't bothered, and a rising tide lifts all boats. And if you're going to do anything, I mean, some of these names, Jamal, that you were talking about, in particular, actually, Costco, Deere, that they're kind of off their highs and maybe near support levels, at least as far as Costco. That's interesting, because at least here, maybe you've got something that you don't have to buy at the highs, where there's kind of an area of congestion somewhere around here. Let's call it between about 909 and 880, something like this. You're kind of in that area. I would argue you don't really have a trigger to go, but names like this could be something that I'm watching. I'm interested in this right here. This is the Japan ETF, where we have had a massive breakout. We'll get to the yen here momentarily, but this has been a huge breakout outside of the US. Any interest here? Can I get you guys into some Japanese stocks?
Japanese stocks? I don't know about that. What's the liquidity on this, my man?
He's not like a door-to-door salesman on that
I'm
one.
sure
Can I interest you guys in some Japanese stocks today?
The only real headline that made any sense over the weekend, and this is how I arrive at Japanese stocks, was the very surprising change of government in Japan. The election over the weekend was for the leadership of the LDP, their ruling party, and basically whoever wins gets to be prime minister in lieu of the one that is just resigned. And the expectation was that it would be Shinjiro Koizumi, who is the former prime minister's son and kind of the continuity candidate on what's going on. And the outcome actually was that it was Sanae Takaichi, and she's very dovish in her BOJ perspective. So she thinks all of this rate hike commotion that the BOJ has been doing is all wrong, that actually they need to go back to where they were under her mentor Shinzo Abe, where they were printing all the money that they could possibly print and doing tons of fiscal stimulus and financing it with massive amounts of central bank backstop. And so, perhaps not surprisingly, Japanese stocks like that very much. And of course, the other thing is the Japanese yen.
So was this here, like a surprise result from this election this weekend?
Yes.
And is this becoming, I mean, to me, that's probably the most interesting. Is this becoming the norm, surprises in elections across the globe?
That is an interesting question. What's the other one that comes to your mind recently? I mean, obviously,
besides
it's not
the
an
US,
election, but the French prime minister resigned today again after a month on the job. This is, I think, not a single French prime minister has served over a year, I think, of the past 3.
Wow.
So they can't really get it together, and they're pushing Macron to hold a snap election and basically rejuvenate the government's mandate, because none of the parties can agree enough to get a prime minister and to get a budget through. So we could get a shocker of an election in France. The election itself is not on the books, but we've lost another government there as of the past 24 hours. Interestingly, the euro could not even begin to notice. So if we look at what the euro is doing here, it just does not care. But this was maybe the other thing that's on my mind here, sort of between the yen, the lack of anything but slow drift higher for equity indexes. This is kind of the other story, the broader dollars story. If there was anything sort of from a macro perspective to look at, and we'll take a look at crude oil in a second, because that might be the other one, but the dollar here seems interesting, because if what you wanted to do was buy cheap and sell dear, as it were, you're not doing that with stock indexes. You're basically saying, okay, well, we're at record highs, maybe we'll get new record highs. And this is something else. This seems to be attempting some sort of a turn. We've stopped falling on the dollar, going back all the way to July. And that's with all the rate cut talk, with the Fed getting Stephen Myron on the board, which is, I mean, as direct of an insertion by the White House as you possibly can think of. And we just saw in the last policy meeting, clearly that's the line that he has taken. So there's all kinds of reasons to be worried about the dollar, and yet it's not falling, which tells me that it's probably getting ready for some kind of a more convincing rally.
And so what do you think? I mean, obviously I agree with that. What do you think is where do you get the most capital efficient exposure to a rising dollar right now, in your opinion?
In my mind, I mean, obviously in hindsight, it was the yen over the past 24 hours. Thankfully, I was already holding it. And so I was able to capitalize, but I wouldn't necessarily jump into it right here. I think the risk reward is kind of shot a little. I think the euro actually looks pretty attractive.
That's been my
here. I think this looks pretty good. I think even if you were very modest and said, look, I just want to come from here through the bottom of whatever this congestion is, and just test right here. Even just that, just simple.
That's been my play. I'm long the 118. I am actually long the 118, 115 put spread in the euro. I'm out in January. I actually was so far out that I eventually kind of turned it into a butterfly, but I'm basically profiting off of this move today to some degree. Not as much as I could have if I would have just had a straight up put spread. I have it as
also
a butterfly
through the yen, Jamal.
Through the yen. Yeah, correct, Dylan. Yeah, I'm doing it that way. Again, I always say this. I wish Dixie was able to trade. I know it's not. I know there's UUP. I don't care about that. It's really the yen and or the euro. And for me, the euro is just the best, the easiest way to play it. It's the easiest way for me to comprehend. Again, I feel like, and this is exactly it, I feel like there's always more geopolitical stuff that pops up via the yen. And while, I feel like, sure, some of the move might have been because the dollar was up today, clearly most of the move from the yen had to do with the geopolitical situation that happened. So, But, and maybe to some degrees, again, the French, premier, the PM of resigning probably had a little bit to do with the fall in the euro today. But I just feel like that's one of the better ways to play it. So that's the way I'm doing it.
Yeah, I mean, and in fairness, DXY, the dollar index, was a basket that was created before there was a euro, and then there was a euro. And so most of those currencies that were in it to make for a diversified basket are now just euro. So that basket is so skewed euro that you might as well just trade the euro. You really don't need to trade the Dixie, because if you trade the euro, you're trading the Dixie upside down. Because there can be other baskets of dollars.
Is so heavy.
Yeah, because the euro weighting is so heavy. There can be other baskets, of course. You don't have to do Dixie. You could make your own basket, whatever you like. Just put together a collection of trades against the dollar, and there you go. You have your own basket. Congratulations. But as I've done, for example, but Dixie itself, if you want to get exposure to the dollar index, it's euro upside down. So you can just
is there a point at which we get a move in the dollar such that it disrupts this gold and silver move? And hell, even include copper in there now. Even copper was, so discombobulated after the big dislocation that happened. And now all of a sudden it's moving up just like it's metal all over again, which makes sense. Is there a move in the dollar? Is there a level at which all of a sudden gold and silver says, hey, we're not supposed to be going up if this thing is actually moving up meaningfully? What do you think it is?
It's an interesting thing. I think the fact that the dollar has been kind of steady here is probably helping the metals rally without having to think about it. Like at the very least, the dollar isn't rallying up a storm.
Yeah, when there's no bullies at school, the band kids can bring their lunch and not have to worry about it getting taken.
See, there you go. But what's weird is none of the bullies are apparently getting paid attention to, including in the bond market, because metals should hate that we have this kind of sogginess in the bonds. They shouldn't, like, this should not be okay for metals. I mean, since the Fed, which is right here, yields have gone up. Metals could not care less. And that's kind of interesting also. They appear to be powering higher despite the fact that, at least since the Fed, let's say, you've earned higher on yields. But we can look at the front end here as well.
I got to tell you, the bonds is probably the
same
one thing
story.
That doesn't make sense to me over the last several weeks.
Same story. I mean, they kind of make sense to me. It's just weird that metals could not even begin to care. So if you look at what's going on in the bonds, let's take a look at the SR3 Z5 contract first. This is for year end. And you can see it's been pretty steady, which tells you that expectations for Fed monetary policy by end of this year, this is December of this year, not really wildly changing here. Pretty stuck where they have been. But if you look at what's going on for next year, this seems to be where the action is. And you can see that since basically the Fed comes out, which is right here, you're going in a direction where you're shaving rate cuts away. So obviously this is the quote. So think of this as the bond price, and the yield is inverse. So if this is going down, then yields are going up. So we're going in a direction of fewer rate cuts in the wake of the Fed, in particular for next year. And we've taken away just about 25 basis points at this point versus what we had in the market before the Fed. In that environment, it does make sense for the dollar to kind of steady and try to bottom. It does make sense for yields to go higher and for bonds to come in. That lines up. Metals could not even begin to notice, though. And you start to get this narrative out there, and I'm curious what you guys think about this. Everybody all of a sudden is a currency market genius, and they've come out and they've said, ha ha ha, well, it's the everything but fiat rally. Everything is going up.
The debasement trade, I think they call it.
Yes. The debasement trade. And it's funny how this happens. People get their little pet in the narrative, and it sounds good when they say it. It feels good to say. It rings accurate-ish to people's ears, but it's obviously nonsense because the dollar is not falling. It's holding, and it's been holding since July. And if this was that kind of a thing, then everybody's favorite pretender to real value would be doing something at least a little bit more convincing than just this pop over the past, let's call it week and a half. I mean, Bitcoin is up to the top of its range. It's pushing past it today, but it's been basically stuck since early July until the past several sessions. Compare that with gold, and it's a very different story. Compare it with silver, it's a very different story. They've been rallying for much longer. So, what are your thoughts? Is this just catch up, or is this whole narrative just wrong?
Which one, the debasement narrative
Yeah.
or Bitcoin as a fiat alternative? Or both?
The debasement narrative, whereby people want to have everything but cash, but
Well, I mean, I
fiat cash.
think that there's two parts to the debasement narrative, which is that the non-fiat currencies, if you will, meaning specifically gold and crypto, and gold especially, is really performing.
Yes.
And I understand your skepticism in terms of where Bitcoin ultimately is, but if you look at its price action the last, basically half of the debasement trade, as far as I'm concerned, is working, meaning the
gold
fiat,
part's working, sure.
And even Bitcoin for the last week or whatever that is, it's just that the dollar's not falling. It's like the non-dollar things are rising. Gold is most obviously.
Yeah.
But the dollar itself is obviously not falling. So,
well, yeah. So the bottom on gold here, if we want to go back and say, okay, so the kind of the rocket ship portion of this move starts, let's call it mid to late August. That's sort of the bottom. And if you want to be very conservative, you say, okay, here's the range top right here. So let's say the breakout is beginning of September. If you look at silver, similar story. Here's beginning of September. We take out the high here. Off we go. Okay. Let's look at what the dollar has been doing, and look at the dollar index here for sanity's sake. Since the beginning of September, the dollar has done nothing. It's attempted to go lower, then it's come back. It's basically where it was. So if this is an anti-fiat, anti-debasement kind of a thing, well, the dollar's not showing it. You'd think that if it would be that, then it would benefit crypto as a kind of anti-fiat thing. And here's the beginning of September, and at least timing-wise, you have to wait until the end of the month. So you need essentially an extra month for crypto to notice, if that's what's going on, if this is some sort of a catch-up. And through all of this, as we were just saying, bonds are down, yields are up, but the overall trend in bonds still higher since the beginning of September. So there's seemingly no kind of issue that people have buying U.S. paper and voting confidence in sort of dollar-derived fiat value that way. So it's kind of incongruous. I mean, obviously, the metals are showing what the metals are showing. There's no question.
I mean, it's not. I would just say it's happened. The dollar has fallen. I wouldn't say it's not incongruous. It's more like locking up the barn after the horses have left. Like the dollar has already been debased, basically. To whatever degree it was, and that happened in the spring. And then everybody saw that, and now it's piling on non-dollar currencies, specifically gold, maybe in anticipation of the more cynical, maybe another view is that gold is telling you something about the future of the dollar. I mean, that the gold owners know something we don't, would be a more alarming point of view, I suppose.
It would be
Jamal, do you think this is about sequencing? To Dylan's point, that basically like some of these markets are just catching up with what the dollar did in the first 6 months of the year and sort of figuring it out? Or are the metals just doing something different than what this debasement thesis is, because they're the only ones that seem to really fit it neatly.
Yeah, this metals trade. I mean, it's first of all, look, on the one hand, on the it's technically clean. I mean, honestly, most of the every time it's been above the 1 week and 2 week moving average. If it retreats, it goes back to that. It doesn't matter if you pull it up on a year to date, on a full year, on a weekly. It doesn't really matter. They've just been pushing higher, and there's a lot of liquidity underneath them. This is clearly a global situation, right? Compared to a lot of some of the other things that we look at, gold and silver, clearly showing you something global. And to Dylan's point, maybe they know something that everybody else doesn't seem to know. I mean, the last time we saw this type of move was 2010, 2011, when we saw gold and silver making these type of moves. And I don't even remember the reason then, but I know if you tried to get in front of it, you lost for the most part. And so that's why I haven't tried to get in front of it. I'm basically waiting on some weakness. I think you have to be smart in this way, because look, this is a momentum play. This is a momentum type of trade. Bitcoin, on the other hand, is a little bit different. I mean, I think, all of the positive news that has come out in Bitcoin, let's think about the last 3 years of Bitcoin. And, it was any negative news, and this thing was getting hammered, getting rocked. The FTX scandals of the world were just weighing it down. And now you have this widespread adoption, and you have all of this fund flows that are going out and buying Bitcoin. And I mean, they're selling it too, I guess, to keep up with whatever allocations they have to in their ETFs. But nevertheless, it's definitely a catch-up play, Bitcoin. And again, you talk about from a technical standpoint, it paid its dues. I mean, forget the long term, just in the recent time, you talked about how the chart in Bitcoin was essentially trading sideways until the beginning of this month, and then it absolutely kind of took off here. So, it's I mean, it's it's fascinating to watch these three, when you talk about Bitcoin, silver, and gold, doing what they're doing compared to overall index level, the S&P 500 and the NASDAQ. I mean, this is going to be a year we're going to be able to look back on and say, hey, remember when it does this? It's just a reminder for people, though. This is a reminder that this won't stay this way. And when it changes, just remember what was happening at the time. Remember how it changes, and trade accordingly.
Yeah, I mean, in a lot of these markets, it feels like you kind of have to hold two ideas in your head at the same time, and neither of them constitute thinking, lest we go afoul of our core thesis.
Don't be using the T word.
Yeah, we can't even be using that word. Exactly. So the first idea is that finding momentum here is silly. And the second is that we're at very heady levels, and at some point you will hit a wall, but there's no knowing where that is. And so you kind of have to be both momentum-minded but nimble.
Well, I'll tell you what, if Tesla announces some fantastic thing tomorrow and that stock is up $100, then you're going to hear more and more people talk about 98, 99. You're going to hear people talk about that time frame where stocks just went up and they swung huge. Because that's kind of, again, I things don't necessarily, they don't, what do they say? They don't repeat, but they rhyme, right? And this is rhyming.
There's an interesting comment on that today.
This is
exactly
with that market.
Yeah. I mean, so you're in very good company on that assessment. Paul Tudor Jones, the great Paul Tudor Jones, came out earlier today. I saw his comment where he was basically likening what's going on here to October 1999 and saying, yeah, the .com whatever is coming, but it's like 5 months away. And what's going to happen here is some kind of a blow off top, where you're just going to have a massive rally into a crash where valuations eventually just feel like they've completely departed any level of sanity, but that the space between now and where that happens is October 99 adjacent. So you have like 5 months of whatever in front of you.
The only problem with that is that markets don't fall like they used to. That's the real problem with that. We have circuit breakers. We have all these different things to prevent markets from doing that. I honestly kind of wish we still had some of that. because that allows the market flush to happen as opposed to the way it did in April. I mean, April and May were kind of painful because they didn't just flush, they didn't just fall. There was all this stoppage, and it took way longer than it probably should have. And so that's the only thing about the blow off top. Like if it happens, it's going to be it's a lot more annoying than scary, if you will.
Yeah. I mean, this was at the beginning of the year, this was a meaningful sell-off and a clean one where things were going down in a semi-orderly fashion. You could find spots in here, and I did. I mean, I got short somewhere around here when you took out this range. You had clean spots to sell along the way. But to your point, this is not sort of fall of '08 where everything happens all in one go. I mean, if we go back far enough here,
look at that. Look how high we are. You got to raise the chart.
Yeah, so let's go to COVID. Here's COVID. I mean, there's some real nastiness here.
Yeah, and that's from February to what? To May?
Also, that's February from to April. No, it's February to late March.
Yeah. See, yeah. And even then, we still had circuit breakers, but that was a lot faster. Yeah. Obviously, a lot more fearful. I mean, hell, a virus that's going to eat your insides is a hell of a lot scarier than tariffs.
Yeah. I mean, this was probably more what I'm looking at. This was the rate hike cycle sell-off in 2022, where we were down basically all year. So we started in January. The turn was October, or what turned out to be the bottom subsequently was October. And we then held basically in a sideways range and didn't get a real meaningful rally until June of next year. We essentially just idled after we set this bottom. Here's, again, COVID. Doesn't look like we can go back all the way to '08 on this chart. But if there were to be some kind of a shakeout, to your point, it would be more of a stutter step in the sense that the circuit breakers would kick in, the algos would kick in, and you'd kind of do this choppy slide lower. I suppose that's helpful in the sense that it would let people get out without essentially just taking everything from them in a day. So probably like a Black Monday kind of risk is probably lower here. But if the Paul Tudor Jones analog holds, and this is sort of like late 1999, then there's a big wedge of time here still before the ridiculousness is ridiculous in the minds of the market.
I don't know, and none of us ever do know what brings that to fruition, but I'm curious of what you guys think about what everybody's saying, all this money being pushed around amongst all of these AI related names. You know, I don't think I've never seen that I can think of, and you two help me if you have, a situation where OpenAI is controlling the fortunes of so many different names, whether it's Oracle, whether it's AMD, whether it's NVIDIA, you name it, insert the tech name, and they're having some type of relationship or some type of money being pushed around. And you know, there's a ton of different memes right now, right? Of the power strips, where you got the power strip plugged in back into the power strip. Is almost if the money is just being pushed around from here. You get it, Oracle. You get it, AMD. AMD gives it back to OpenAI. What do we think about that? I mean, is that something that eventually leads to this correction that we're potentially going to see or not?
Sam Altman is J. Pierpont Morgan. And OpenAI is the House of Morgan, iteration first and probably second under the sun, but Jack Morgan. But sort of my mind immediately goes to when we didn't really have a central bank, we didn't really have economic policy making that was very advanced. We had J.P. Morgan, the man, and when things went wacky, he went and kind of told the markets what time it is, and organized consortiums of companies and had people on the boards of those companies and controlled those companies both directly and indirectly, and essentially ran the entire economy. It didn't end great. It ended with the railway boom and bust, which was a very similar episode to this, where at the direction of, in many cases, J.P. Morgan and sort of adjacent banks and a very small group of banks, we built a ridiculous amount of railroads, and just supply and demand didn't match. There was lots and lots of hype and lots of supply, and it did not match demand. And that was telecoms in 2000. In many ways, that's AI now. There is a ton of AI supply that's being built with data centers and et cetera, et cetera.
There's more than that. I mean, AI.
It's not a lot of demand.
Even if the layer, I mean, I disagree with you a little bit. The layer of AI that is basically super search, right, is pretty much deployed. Most of the people that I know now, compared to a year ago, use Gemini or GPT at least as a super powerful search tool.
Or Perplexity, or something. Some
iteration of it as sort of super, right? So it's not just building the picks and shovels. Now they're not mining giant, like, let's call super search, gold flakes, right? They're not pulling out huge chunks of gold from the side of Mount Tamalpais or whatever, but they are pulling gold flakes with super search. And then I also think that a lot of people, probably not as many, but a lot of people still are using it for some version of drafting and writing, marketing emails, and like sort of rudimentary communications, at least in terms of drafting. Now, obviously, some version of extremely developed search plus some document drafting doesn't justify the enterprise value of the Mag 7 or anything close to it, right? But I do think that the expectation is, and I think that's why you get the doomsdayers out there like me with the murder drones and whatever, but that the expectation is that basically all operational function from logistics, communication, marketing, driving, legal, and all analysis, that this ends with only the most extreme philosophical analysis, because I think the financial modeling at the investment banks all goes over to AI and goes away from the analysts and the juniors. You're kind of left with the creative professions, super senior people across every profession managing AI. And I'm not trying to get into a labor market discussion. I'm just saying that I believe the reason that the Mag 7 have as much value as, I believe, there's no way that the Mag 7 could have the valuation they have if the expectation wasn't what I'm describing.
The expectation, yes.
The only way you can justify the present value of the Mag 7 is on the expectation that it is going to do what I just described.
I think that's exactly right.
And you're going to say it's about when, and who knows, and I'm going to agree with you, right? I mean, that's why this is a wild situation.
To this point, obviously people are studying this very question ad nauseum, and for good reason. Exactly what you've just described. The valuation of all these names is based on the idea that all this boom in supply and the valuation of all of these names that comes from said boom, baked into it is the assumption that this supply will find demand and that ROI will be had. And obviously we've had a variety of data points, including from, let's say, MIT a couple months back, that says, look, this stuff is not getting adopted at scale. That is already shrugged off by the market. But another one just this week from McKinsey saying that while consumers' use of chat bots is rising, the success rate of AI pilot projects in firms that McKinsey surveyed was less than 15%. Now, obviously, that's kind of a fuzzy thing, and we're looking at it's McKinsey.
Here's a game I'll play with you, both of you. Would you rather be short the Mag 7 or gold? If you have to be short one.
What time frame? Are we talking for the next week? Are we talking for the next 6 months? Or are we talking about the next year?
The tasty root fundamentals, the next 45 days.
Oh, like volatility short?
Or no, directionally short, but for a month or two.
Directionally short?
Directionally short?
You have to be short one. You can either be short the Mag 7 or you can be short gold.
This is a question.
I'll go first. For sure, I'm short gold. Forget the Mag 7, you're a dead man walking. At least with gold, you have a chance that the dollar rallies, that sort of offsets it a little bit. And you know, and I don't, and for me, I don't see how I can like the dollar and not be, at least in terms of sentiment. I'm not saying that I'm financially short gold, but how can I not hold a marginally bearish point of view on gold if I have such a strongly bullish point of view on the dollar? So if you put a gun to my head,
long both,
and I have to get short, what's that?
I'm long both. Although I'm long silver.
No, of course.
Fairness.
You're long gold and the dollar.
I'm long silver and the dollar. I got shaken out of my gold position a few weeks back, but I've been holding silver for a long time. So I am both long precious metals and the dollar.
Yeah, but that's different.
I would short the gold. I would short gold. That would be my answer. But
you wouldn't short gold other than my sort of false construct, I presume.
Not at the moment, no. Short gold. I am interested in getting short gold. I as a person who loves to trade momentum plays, I just don't see the usefulness of doing it at this point in time. But sometime soon.
I agree. I mean, if I had to short one, it would be gold for this reason. Gold is an actual two-way market. There are buyers and there are sellers, and there's not a bias. There is just whatever the thinking is. And if I had to pick between two markets that I think are both overdue for a correction lower, I'd rather be short the one that doesn't have gazillions of pension funds and endowments that are perpetually long, that never short, and that are the biggest holders of the assets in the space. So the stock market is obviously biased higher. So I think it's going to have a harder time falling than gold is. And if it were to fall, gold would fall harder, one would think, just on liquidity and momentum grounds. I wouldn't sell either here, but if I had to sell one within sort of this construct, Dylan, it'd be gold because it's an actual 50-50 kind of market, whereas stocks are biased.
I mean, the Mag 7 is kind of a landmine. I mean, if you look and over the last several weeks to months, there's always some type of news that comes out in any one of these names, whether it's Apple and Google / whatever happened with the antitrust situation, Tesla more recently, and maybe even Tesla tomorrow, Nvidia with some however many billion-dollar deal with OpenAI. Like, it's kind of a landmine to try to be short any of these.
I tell you what, though, if you flip the question and you ask which one of these would you buy, like what would you buy? Like if you had to buy one, the Mag 7 or gold, it'd be Mag 7 for sure.
Yeah, for that exact same reason I just said.
Whereas gold has been vertical, just look at this Mag 7 ETF. It's in a range. It maybe has legs. More.
Mag 7 does.
Yeah, Mag 7 does.
Yeah.
Because if you look at the overall ETF here, I mean, it's basically been in a narrow range since the Fed. The Fed is right around here. I mean, this is the actual Fed, so you get a little gap into the week of the Fed. Monday, Tuesday of that week, you kind of idle. Here's the Fed itself. Since then, you've been in a range. I mean, obviously, individual names have done individual things, but this overall Mag 7 ETF has been basically sideways. So if you're going to look for any kind of value, and I mean, and there's a little bit of IV to work with here. So you could be selling puts here, maybe. So there is actually something to do, whereas gold has been parabolic. So
Yeah, I mean,
if there was one to chase, maybe this one after a digestion period rather than gold after no digestion period.
These things are like superheroes. They all have their own individual story. I mean, they really do. And they, Dylan mentioned Amazon earlier. Amazon's been fairly quiet. All it takes is for some type of situation to come out, and that's going to pop off. We just saw Nvidia pop off not too long ago. We've seen Tesla do it. So that's the easy answer for why you want to be long Mag 7, because they always have something that could pop up news-wise.
And
Send Tesla humanoid robots to run Amazon distribution centers, and you have both.
Yeah. I mean, that's why I like Amazon, just as a bet on the rotation within the Mag 7 for like a popcorn popper.
Mm-hmm. Before we get off
at the moment.
Before we run out of time here, the one thing I wanted to make sure we look at today is crude oil. Because if there was ever a move, I mean, this actually is starting to look like it's doing something, finally. And we're going to take these moving averages off because they're more lines than I would put on a chart. But you seem to have had a break here, finally. And a break and a retest. And as much as I love horizontal lines because they leave no subjectivity, you can kind of get a sense of what's going on here. So clearly this was being held, and whatever you saw last week, there was a break. There's a little bit of a retest here. If you read the mainstream finance media, it's because last week there was expectations that OPEC was going to massively boost production. I personally could not care less what OPEC and OPEC Plus do. I think they're useless, and they've never really met their quota since they decided to have a collective one in 2014. They say things, but they never make good on those things. So I don't think anybody should care, but markets do. So apparently. So this thing sold off hard on Friday. It's bounced a little bit today. The OPEC announcement came today and was a little bit underwhelming. They didn't boost output by as much as markets thought. Let's pretend for a second that this matters. So we'll get a little bounce, but ultimately the break holds. So I'm a little bit short oil here, just to see where this goes now. In a risk-defined put vertical kind of way, I'm doing it through USO so as not to run into larger futures contracts and keep this very sane. If not Japan and if not the yen, can I get you into a crude oil short here?
We got competing trades, buddy. I'm long oil from 60, 80 for a small pop. We'll see what happens. This has been one of the more boring trades in the market compared to the rest of the stuff that's going on. And it's either going to bounce back up and then fade again, more than likely. And it's kind of quiet. And until it shows something along the lines of a lot of the things that we talk about with volume, the gold, the silver, whatever else in the world, I'll get heavy into it. But for now, I just got a small trade, and honestly, I could care less what happened because I don't think a whole lot's going to happen with it.
Dylan, any appetite to take oil anywhere, this way or that?
Unless it's clear geopolitics, I won't play. I don't have a. I view it as a great sort of short and the situations that but outside of that, I try not to get involved.
I will say, since we're not getting economic data, the ISM numbers that we got last week were pretty awful. They do suggest that the U.S. economy has stopped, essentially. It's not shrinking, but it's not growing. So that'll be an interesting thing to monitor here in the coming days. And what do you know? Macro Money is coming up momentarily, where we're going to go over all this stuff in excruciating detail. So don't go anywhere. I'm about to bore you to tears for 30 minutes with macro charts on macro charts. And we'll be back with this show tomorrow. Thank you, gentlemen.
Delta, Vega, Gamma, Theta. It's all Greek to you. Well, guess what? Millions of people speak Greek, so you've got no excuse. Here's your alphabet. Theta is time decay. Time itself has value in the options world, and that value slips away the closer you get to expiration. Theta is how fast that happens. Tick-tock, time value drops. Delta is difference. How much does a $1 move in the underlying affect the price of the option? Long options have a positive delta because their value moves with the stock. And short options have a negative delta because their value moves opposite the stock. Gamma is get up and go. It's how fast delta changes. Gamma increases when the options start trading much more like the stock. Like the closer to the at the money and the last few days till expiration. Vega is not a Greek letter, but it does start with a V, and so does volatility. Vega measures how much the options price is affected by the changes in volatility. Now you know your alpha, beta, gammas. Well, gamma anyway. Pretty simple.
So you're an active trader, looking to increase your return, decrease your risk, or quite possibly both. Sure, you've heard of the Greeks. You know, your deltas, your thetas, your vegas, your charms, your vamas, etc. And you're wondering, hey, how do I use these guys to improve my risk-return relationship? Well, join me for a 10-episode crash course, and I'll show you exactly how to do it with all the gimmies and gotchas, one Greek at a time. We'll see you there.
What's up, everybody? Check out my new series, Life Cycle of a Trade, where I show you my real-time trades with insights into strategy selection, adjustment mechanics, all the way to the closing order for all of the tastylive core strategies. Look who's back testing. tastytrade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at tastytrade.
When you define risk, you set a limit on how much you could lose if the trade goes bad. If you have a small account, you might not be so interested in selling naked options. You'd use up much more buying power, and the risk is undefined. Defining risk, though, controls how much you can lose if the trade goes sour, and it gives you back some of that sweet, sweet buying power. We can define risk by combining options into certain strategies. The short put vertical spread is the simplest one. Selling this put sets your max profit with the credit, and the long put at the lower strike blocks off the risk where you want it. And if you're more neutral than this, you can throw on a vertical call spread to make it an iron condor. The only downside to defining a risk is that it lowers both your max profit and your probability of profit. That little compromise might mean you rest easier, though, and a good night's sleep is priceless. So see, we can define risk when we use more than one option at a time. Pretty simple.
All right, so I've got some good news, and I've got some bad news. Let's get that bad news out of the way first. You are going to have some losing trades. Like every trade you place, despite your extreme optimism that it's going to work out, is not going to work out. That's the bad news. The good news is at Tasty Trade, man, we are ready to adjust and defend and roll our positions if that's what it takes. And that's what this entire crash course is all about. A 5-episode crash course all about rolling. So I will see you inside of episode number 1.
Tasty Trade has crypto, and you can trade with 0 commissions: Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
No data, no problem is apparently the message that we are getting from financial markets. We, of course, had a jobs report that didn't come out last week. We had a bunch of other pieces of data that will not come out while this U.S. government shutdown continues. But the markets do not seem to care. What we have instead is a relatively sanguine sort of start to the week. So what does it all mean? That's what we're going to try to figure out here on Macro Money. This is Ilya Spivak, head of Global Macro here at Tasty Live. And what we're going to do here first is just take a look at what the markets did last week, how they are shaping up for this week, and what that might mean going forward. Because, of course, we are, much as a Fed official might bemoan at the moment, flying kind of blind as we look at what these markets are shaping up to be doing and what that might mean going forward. So let's first and foremost here take a look at what these markets did last week and see if we can't divine some sort of clarity out of all that. We can see a modest rise for stocks last week. We get a bit of an increase, 1% for the S&P, a similarly sized one for the NASDAQ, though a little bit stronger there. We likewise have a interesting perspective on yield. So this idea that the market is primarily concerned not so much with economic outcomes as it is concerned with how much easing is going to come to give the markets this kind of resilience about what is on the menu next and give them the defenses that they need to weather whatever may be coming down. That sort of logic seems to be prevailing here. And what we're finding is that the sort of patterns seem to be holding. And in that sense, we have the kind of setup that we've been looking at for a while, which is to say yields down, stocks up, gold higher, the dollar a little bit weaker, but ultimately not going very far. The euro, we can see, gained a little bit, 0.3%. The yen gained a little bit. That's 1.2%. Bitcoin doing its risk appetite on steroids thing last week, up 12.6%. Crude oil still on its own mission, down 7.4%, ostensibly around rumors that OPEC plus the OPEC cartel and like-minded non-members like Russia, say, they are or were going to announce a big output increase. That was the scuttlebutt last week. Whether you choose to take OPEC and like-minded producers seriously, OPEC plus the sort of bigger grouping, that's not something that I sign up to. I don't think they're a very effective and a very clearly impactful force on the market. But nevertheless, speculative juices can be activated by things that don't actually work. If enough people in the markets want to act on it, that's all that you need. And so we end up with this big crude oil sell-off. If we look at the way we started the week here, and this snapshot was taken a bit before the close, so things moved around a little bit since then, but only a little bit. The thrust of what happened here is about as it presents itself. And again, you see stocks are higher. You see NASDAQ leading a little bit, and that speaks to tech outperforming amongst the major sectors here today. Yields, interestingly, higher, but not really moving outside of their recent ranges, so it looks like more digestive than a change of direction. Crude oil bouncing a little bit, although, of course, last week's sell-off makes this bounce a drop in the bucket, as it were, and more corrective. But that OPEC announcement didn't come out, and they delivered a output increase that was smaller than some of the whisper numbers, and so perhaps that's what's going on here, but only a slight correction for oil. Gold continues to power higher. The dollar back on offense, that's largely thanks to a big move in the yen. The yen cracking lower here by almost 2%. That's after elections over the weekend, where the very dovish candidate for leadership of the ruling LDP party, Sanae Takaichi, won unexpectedly. Shinjiro Koizumi was supposed to win. He's the son of former Prime Minister Junichiro Koizumi and was the sort of continuity candidate. But instead, we have somebody that favors the Bank of Japan abandoning the rate hike path that they've been taking, and instead going in a much more dovish direction. Sanae Takaichi is the protege of former assassinated Prime Minister Shinzo Abe, and his sort of approach to things, and that was get the BOJ to pump out as much cheap liquidity as possible, and then fiscal largesse gets paid for, and on we go. So that seems to be her logic too, and in the wake of that surprise leadership contest outcome, she's now essentially sliding in as prime minister, taking over from Shigeru Ishiba, who's resigned, having lost his mandate. And so we are in a sort of move here for the dollar, it seems like, whereby the dollar had a big rally against the yen, and that's kind of knocked other currencies with dollar strength as a sort of ripple effect. And that's what we're seeing here. In other news, of course, France's prime minister resigned, but that doesn't seem to be having a meaningful impact on the euro directly. As far as data is concerned, because, of course, we are still in the midst of a government shutdown, as we mentioned at the top of the show, so we're not getting economic data that we might otherwise be getting. We didn't get employment data in particular last week. the very closely anticipated employment data. Instead, we got this ISM survey results. This is from the Institute for Supply Management, and probably the latest meaningful barometer on where the U.S. economy is. And this does seem relatively supportive for risk sentiment if the markets don't care about having a good economy and all they care about is having rate cuts, which seems to be still where we are. The number for manufacturing, as we discussed last week, a little bit better than expected in the sense that 49.1 is a slower contraction in manufacturing than the expectation, which was 49. As ever, these numbers are done in the logic of PMIs, so 50 is neutral, above 50 is growth, below 50 is contraction. The further you go below 50, the faster the contraction. The further you go above 50, the faster the growth. And what you see on the services side, this is the number that came out on Friday, and of course the much more significant number, because services are a much bigger piece of the U.S. economy than is manufacturing. The expectation was a relatively steady result, and what we ended up with was stasis. The service sector has slowed down to standstill. Taking that together with the 49.1 on manufacturing, the economy as of this data, this is September data, seems to be at best idle, at worst narrowly shrinking. And that also, that obviously depends on how you weigh the two sides. Services are a little bit more impactful. As we said, they're a larger share of the economy than is manufacturing. And so you would err on weighing the 50 more than the 49. So maybe we're closer to standstill than we are to a contraction. But this ought to be music to the ears of rate cut hopefuls, because, of course, this suggests that there's not an inflationary risk that the Fed necessarily needs to worry about. It can focus on boosting growth. Now, sub-indexes here on this. On the prices front, a little bit softer on price growth, although, of course, it's still very elevated, a little bit lower on manufacturing, and at the very least, not meaningfully higher on services. So this rapid rise in inflation that we saw from the beginning of this year for both manufacturing and services, in large part thanks to the tariffs, we don't have that getting worse here in these most recent numbers. Meanwhile, the situation with employment still points to contraction. Obviously, both these indexes are sub 50 for both manufacturing and services. And so you get a sense that inflation didn't get worse, employment kept shrinking, the Fed can keep cutting rates. Now, in lieu of meaningful data this week, there's not much to anchor around, but there is a little bit. And the focus here, of course, on the absolute avalanche of Fed official commentary this week. Perhaps they feel like they need to be communicating with markets more robustly in the absence of data. You've got here speeches from everyone under the sun on the menu this week, starting tomorrow, including Fed Chair Powell on Thursday. But the big standout as far as releases go is Wednesday's FOMC minutes from September's meeting. Now, looking at the policy statement from that meeting, just to refresh ourselves, this is where the Fed begins cutting rates. The logic here is familiar. Job gains have slowed is the edit here, and the unemployment rate has edged up. We see that the committee is attentive to risks on both sides of the dual mandate and judges that downside risks to employment have risen. That's how this rate cut is justified. Then, of course, we get this summary of economic projections where you get an interesting story. Expectations for growth and inflation are nominally revised higher. Expectations for the unemployment rate next year and the year after are revised lower. Nevertheless, I mean, you'd think those are not dovish edits, but nevertheless, we get a situation where we get 3 rate cuts on the menu for this year, from 4.4 down to 3.6, 1 cut next year, 1 cut the year after. We had 50 basis points already on the menu for this year. We now have 75. In large part, that's thanks to this out there dot, almost certainly coming at us thanks to newly minted Fed Governor Stephen Miran. He was the White House's insertion onto the FOMC, and clearly takes the White House's view, a much more dovish view. And so based on this kind of far away from consensus dot here, we end up narrowly with a 3rd rate cut in the forecast. From the market's own perspective, they too are more dovish than the Fed is signaling. They're looking for at least 2 cuts next year and about a 50-50 shot on a 3rd. For this year, looks like we're at 37 basis points, so at least 1 more cut left. That's net of the one that we've already seen. And about, let's call it 12 basis points in the direction of a 3rd. So nominally speaking, this would say that the probability of that 3rd cut is about 50-50, but the markets are much more convinced. So here's the October meeting, and we can see that we're well into the high 90s for the likelihood that that cut occurs. Not exactly controversial. And for the December meeting, this is where it's a little bit fuzzier, but nevertheless, we're well north of 80% today. As of Friday, obviously a week ago, we were closer to 60%, but we're still solidly better than even going as far back as a month ago on that 3rd cut. So the markets seem pretty well priced for what seems to be going on here. And so we're going to be looking at these minutes and trying to divine whether there's anything there that gives us a sense of why it is that the Fed is so narrow in its forecasting, and see if what the markets end up with is ultimately something of a letdown. Because if we look at, again, the way that these relationships have worked, we can see very clearly that after this kerfuffle with Liberation Day, where stocks ultimately find their bottom, and it turns out that against all odds, the administration is in fact amenable to market discipline and is in fact of a mind to back up when things look hairy. You get that very clearly in April, where the markets get, as the president described them, a bit yippy, whereby stocks, bonds, and the dollar all fall at the same time, and the administration backs up, and there's a 90-day pause, and things even out. And so on that basis here, we seem to have a recovery in sentiment, but not so much a recovery in other things. If you look at monetary policy expectations here, they travel a little bit with this recovery, but then go into a dovish direction. And so it seems like the rest of this rally from, as we've pointed to before, about here, which tellingly is the same spot right there where the break initially occurred. So from about here onward, once you've recovered this this period of risk aversion, this seems to come alongside with increasingly dovish policy expectations. And when we initially got the rate cut here and things stalled, it seems like stocks stalled as well until we started going back into a more dovish direction once again, and there was resumption. So it seems as though the markets really are of a very simple mind here and saying, well, if there's more cuts, that's good. If there's not more cuts, then not so good. It's a very similar story in the dollar, where we can see that the dollar is attempting to bottom here. This is the low from July, and we can see we're holding on to those levels here. And as the rate cut cycle starts and expectations for further easing dilute even a little, the dollar seems to be done falling. So this is the question du jour. How is it that the Fed is forecasting faster growth, lower unemployment, faster inflation, and only one cut next year, and yet the markets are much further out on that forecast, and that hasn't bothered anyone so far? So that's what we're going to be looking at in these minutes and seeing if, in fact, the Fed can make the case that we don't need as much easing next year, which, of course, the markets wouldn't like to see, and then perhaps see if that makes a difference to sentiment. For what it's worth, the Atlanta Fed GDP Now model tells us that economic data coming out and feeding into third quarter GDP growth expectations has been broadly positive. That's how the slope of this line ends up looking this way from the forecast model. We likewise see from the Citi Economic Surprise Index that U.S. economic data has tended to surprise on the upside going all the way back to July, which may actually explain how the dollar is as well positioned as it is here in the start of that recovery. And so, such as we get from economic data seems to be suggesting that maybe the Fed is right, and maybe the markets are hoping for more than they're going to get, which presents a point of contention. The only piece of data that we might get this week that might meaningfully illustrate this outside of the pharmacy minutes is the University of Michigan Consumer Confidence Survey. We're expecting weaker readings here. The sentiment index expected to come down. The index measuring current conditions expected to weaken. We'll see if this gives us any kind of extra guidance on what's likely to happen next, because of course this is consumption, and that's well over 60% of economic growth. So if the economy is in fact at standstill, as this seems to imply, then maybe in fact the Fed can be convinced to give us more rate cuts if consumers dial back or keep dialing back inflation expectations and sentiment is a little bit better anchored for it. And that is macro money for today. As ever, we are here Monday through Thursday, right after Overtime, a show I co-host usually with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Likewise, writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
When the market moves, traders need to move faster. tastytrade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, tastytrade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on tastytrade.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
In the world of investing, a beast lurks between the numbers, ready to pounce. Some traders hide from it, some ride it. If that's you, join us on Tasty Trade. Genius loves company.
All right, we're back. Tasty Crypto Show. I'm Ryan Grace. With me today, of course, Shelly Van in the house. Shelly, what's going on?
Hi, Ryan. All-time highs.
Yeah.
It is up October.
It is.
So this is exciting.
You think it continues, or did we, like, I guess, use all of our ammo? I was going to say something else that's probably inappropriate. Did we, like, fire all our shots here within the first week? What do you think?
No, it keeps going.
Where do you think it goes to? New all-time highs. I mean, you got the sky's the limit, I suppose.
Sky's the limit. I'm just very, very excited because my very trenchy wallet is looking nice.
Okay.
First time in a long time.
Altcoin season soon, maybe?
Yeah, for me, I'm like, it's here.
For anybody that's not familiar, can you explain what you mean by trenchy wallet?
Trenchy wallet.
I like, because I like that. I've never heard that before. I've heard, in the trenches, referring to just trading meme coins and the volatility that you have to be able to stomach there. But yeah, I guess maybe more so, what's in your trenchy wallet?
Okay, so I never really gave up on the AI agent tokens. Remember when we were dabbling with those?
Like AI16Z, some of the others.
Virtuals.
AI XBT is still on X, is always posting content.
I just had a nice trade on Tibber, Tibbr, I think.
Okay.
That's a virtuals agent. And virtuals, we should do a whole show on that again, maybe on Beans on Friday, because they have a whole new ecosystem. I don't know if you're still messing around over there.
I haven't looked at it in a while. I think I probably have some, maybe we'll refer to them as residual investments. They become positions, they start as trades. I think I've got something somewhere in a wallet, not of any meaningful size, but I will have to take a look because that was a platform for launching these agents, right? Or launching the tokens that represent the agents.
Yep.
What are they doing now that's kind of evolved?
So if you stake virtual token, you will earn these points that you can then, I can't remember the word, but you can basically attribute them to up-and-coming agents that you think are viable.
Okay, almost like a vote or something?
Kind of.
Okay.
And then if they do take off, you get allocated some of the token. But it's very community, it's like super community focused, and I don't know, I've just been having a good old time playing around with them.
Awesome.
And then Dan and I called Punk Strategy at a penny.
It was a good one.
Hit 32 cents this weekend.
Wow.
A penny to 32 cents.
Does it keep going?
Yeah, I think so.
Yeah.
It's dipping now, so I'm buying that dip.
So you buy, I was going to ask, are you taking profits? You buying the dip? What are you doing here?
Buying the dip.
Awesome. That's a hell of a trade. Yeah. No, seriously, congratulations, because not often do you get in at that level and then you see the explosion. It does happen, obviously, and we see it at times on X and elsewhere, but nice trade.
Thank you.
Yeah.
Thank you.
Well, let's jump into the show, Shelly. Let's talk a little bit more about the all-time high in Bitcoin, maybe what's behind it, whether or not this keeps going. And the theme of today's show, which I like what you appropriately titled it here, Bitcoin's gold moment. And we're going to tie that together as it pertains to kind of what we're seeing in maybe more of the macro economy with the backdrop there, what's supporting markets, what we're seeing as well with commodities, and this bid into kind of inflation proxies and why maybe gold should be higher. Who knows? I know a lot of people are kind of looking at this move and saying, all right, it's going to reverse at some point. It hasn't yet. Maybe it will. Or maybe, why maybe Bitcoin will catch up to this here and you could see a broadening of, of this rally. But let's talk a little bit about that and kind of what is behind some of what we're seeing here. Before we do, though, we got to throw up the dancing cat.
I have to have dancing cat.
You have a cat? You have a dog? Any animals?
I had a cat, a tuxedo cat, and he lived
Forever.
Like
too long, maybe?
Maybe a little, because it was like our lives were moving on, and it was like, okay, we have to rehome him now because this is like the kids are leaving for college, and this cat just won't die. He's in his 20s.
I was going to say, or ask you, about 20 or so, because I think that's the age where it's like, we love him, but we didn't think he was going to be 23.
Right. Like, it's time.
Yeah, slowing down a little bit.
Yeah, it was
tough.
very sad.
Well, what was your cat's name?
Stewie.
Rest in peace, Stewie. Bitcoin all-time high. Also, I forgot to mention, but I think everybody knows by now, if you're not streaming over on the tastylive YouTube channel, get over there, type some crazy shit into the chat. Join us. Grumpy Mike, Gary, Nancy, Jose, gang's all here. Gary had a fish once.
How long did that fish live?
Sometimes they live a lot longer than you might think. Goldfish from the carnival 2 years later, going strong.
Wow. Speaking from experience.
Oh, I'm just saying that could happen.
Oh, okay.
Yeah. Bitcoin all-time high. Bitcoin crossed 126. I don't know exactly where we are now. Somewhere around there, near all-time highs. Put it in a new all-time high at that point in time. It's the ETF flows that are very supportive of the asset at this price, right? It kind of look at this and say, oh, well, obviously, but not always. And that wasn't necessarily the case in the past. Sometimes you just get these auto liquidations, they amplify volatility one way or the other, and it takes you to some prices that maybe you don't stay at. But I think here, you kind of look at this and say, is it real flows? Is it real money that's driving it? And I would argue that yes, it is. Let's just jump over to spot Bitcoin ETF total net flows and ETH total net flows, which have picked up a little bit as well. Shelly, here's the last month of Bitcoin ETF flows, and pretty consistently getting, on those big up days, 500,000 in, $500 million in, $1 billion in, and hitting some bigger numbers on the ETH side too.
You must be excited about ETH.
I'm feeling pretty good, but that's not yet at an all-time high. I do think you get there. I've got a price on the screen here of 46.84 in Tasty Trade, up about 3.5% today. But you need to see that at 5,000 plus for it to be a new all-time high. So Bitcoin leading the way. I do think others catch up. I think ETH will be one of them. But you're definitely seeing the ongoing institutional adoption, and you have been for some time with Bitcoin, certainly seeing it with ETH. It's possible that we get the approvals for Solana, XRP, even Polygon ETFs.
Strange one.
Yeah, there's a lot of ETF filings kind of out there. Now, the government, as everybody knows, has been shut down, hopefully temporarily. Most people would assume temporarily. You can go to Polymarket and see what the odds are for when we open back up. So the SEC is kind of on pause here, but there was a change, I believe, made last month that should expedite possible approval processes for commodity ETFs, and digital assets certainly fall within that segment. And so you could see a lot more in the future. I'm not saying it's coming, immediately, but there might be a quicker path or speed to market for some of these products going forward, which I think, again, just induces more or incites more capital inflows into some of these other tokens. But probably Solana is the next big one, I would think.
I think so too.
Did you see that? I think it was Grayscale. Yeah, Grayscale Trust and the exchange traded product there, ETF, is now. And I was confused about this. I don't know if you saw any details. I thought it required SEC approval, or maybe however they're doing it. Maybe they're just going forward. I don't know. Maybe there are no rules anymore. But they are staking the ETH, some of it, in some capacity, and will be passing those staking rewards on in the form of a yield or a dividend, I would assume.
That's huge.
Because I think others would follow suit, right?
Right.
So hopefully, I guess for anybody like myself that's got a little bit of an ETH bag, you get that, and that just brings more participation. I talk about it like it's just greater fool theory. Hopefully I can sell it to somebody else higher,
Can we just give my dad a shout out? He's officially.
Yeah, let's shout out your dad. Is he watching? Is he in the chat?
Probably not, but.
Is your dad Gary?
No.
Okay, no.
Dave. Dave is my dad.
Dave's your dad. Okay. Gotta get him in the chat.
But he is officially a Tasty Trader as of today. I got him all set up with his account, and he funded it. And he's like, you might have heard, he called me today. He's like, I got my account funded.
Oh, I didn't know that. No.
So game on.
Okay.
Dad is in Tasty Trade.
Yeah.
And he wants to get on crypto specifically. So
Beautiful.
I was like,
okay.
Yes.
Welcome to the pirate ship, Dave.
Yep. So we're here.
Riding off into the
Calling
sunset.
tops. My dad's in.
Yeah, do with that what you will, right? Maybe that's some alpha. Shelly's dad is getting into crypto. All right, ETF flows are supportive for sure. Again, you want to see this continue. Obviously, you're going to get those outflows. You saw that a little bit when we dipped earlier in September, a month ago or so. But to start the month, end of September, as you can see here on the screen, big moves to the upside, $1 billion inflows. And when you look at this in aggregate, right, so we're looking at day after day. So you get $500 million, $500 million, $750, $1 billion. Next thing you know, you got $6 billion in new money that's gone into the ETF. So that definitely can help to take you to new all-time highs. But I want to talk a little bit more about maybe the reason behind some of these capital flows, right? Why are investors making the decisions that they're making? And I think a lot of this has to do with the macro backdrop. And so what do we mean by that? Well, look outside of crypto for a second, and you have many other assets, the S&P 500 putting in all-time highs, gold putting in all-time highs. And on the other side of that, you've had a weakening dollar up until recently. A little bit of strength. Maybe that dollar move, for the most part, short term is over. We'll see. But global liquidity has been pretty ample. You have interest rate expectations that are falling, not just here in the U.S., but globally, maybe more, or most importantly, with the Fed, and arguably a Fed that is cutting interest rates into an environment that seems, at least given kind of the nowcast, the forecasts that do exist, seems like it's pretty supportive, which, for what it's worth, I don't think we've seen this since maybe 1998, where you had very supportive monetary conditions into an economy that wasn't necessarily falling apart, right? Most of the time, we're seeing emergency interest rate cuts, we're seeing loose monetary policy to support a slowing economy. And, you're seeing some signs that maybe consumers are in trouble in some cases. A couple red flags are out there, but generally speaking, at least what we know today, it doesn't really seem like we're in kind of a recession necessarily.
Mm-hmm.
So cutting rates into a expansion, possibly, could be a very big thing for asset prices. And maybe they continue to bubble higher, and eventually that does end. But I don't think it's today. It doesn't seem to be when you're hitting new all-time highs. We'll see. So I want to look at the market a little bit more closely here and kind of jump around, because I believe that what we are seeing is true, and that you are moving into an environment where not just in the U.S. but globally supportive of asset prices. That can change, and we'll update everyone when we start to see any signals or signs of that. But one thing that I think is interesting to look at, and then we'll jump into the performance dashboard. But Shelley, I wanted to look at today, the correlations are one thing, and there's not anything that has a really strong positive correlation here. But when you look at kind of the broadening rally in commodities, that should in itself be a sign of relatively robust economic growth. You're starting to see a bid into assets that'll, I don't want to say necessarily like give you a hedge as it relates to inflation, but more so it's like, all right, this stuff's going up. How do you participate? Mm-hmm. Right, and so we go from S&P's at an all-time high, gold, silver's trading better, and now we're starting to see platinum trade much better, or has been, over the last few months. Copper starting to participate. The outlier here is probably, when you look at the energy complex, is still crude oil and natural gas, but trading better, possibly bottoming. Starting to see a little bit more strength in natural gas here recently than we're seeing in crude oil. But I think this is important to pay attention to. So on one hand, we have 15 and 30-day correlations, which if we just use the S&P 500, for example, you look back over a multi-year period and you can look at these, short-term, 15 days, 30 days. A lot of times we like to look at a 90-day rolling period. And the highest or strongest correlation in there is around like 60%, 0.6, maybe a little bit higher. On average, we kind of see a correlation of about 0.4. Okay. So a little bit below there, and in the last 30 days, really no correlation. I don't read into this too much other than we observe it at times. On the flip side, you have an inverse correlation right now with platinum and silver between Bitcoin. But what's interesting to me outside of those correlations is just look at the performance of equities, look at the performance of gold, silver, platinum, copper, maybe a little bit of strength. We'll keep our eye on crude oil. But I would assume, and somebody goes, I think it was my dad told me, it's like, oh, you make an ass out of you and me when you assume, right? That's the saying. Mm-hmm. But presumably, if we see a broadening in commodities, we see equities and risk assets continue to trade higher. And just because they have in the past doesn't mean that they continue to or that they will. But if we do see that, I think crypto does the same thing. Mm-hmm. What do you think?
I mean, I do not have the macro mind that you do, so I just agree with you by default. Because Chat, he talks like this all the time, and I'm like, running to catch up. And yeah, it's slowly, after about a year, Ryan, making sense to me.
Okay, well, that's good. Uh-huh. Yeah, I mean, it took me a long time, and I think maybe more so, a lot of mistakes that I learned from to kind of understand, at least high level, what some of the drivers are here. Mm-hmm. And it does not mean that when we see gold up 30% or 20%, silver up 30% in the last quarter, that crypto is going to do the same thing. And when we look at short-term correlations, they're not even moving in the same direction on a day-to-day basis. 27% of the time, silver has been moving in the opposite direction and Bitcoin in the opposite direction over the last few weeks. So just because gold goes up doesn't mean that Bitcoin's going to go up, obviously. But I think when you have an environment in which asset prices are bid, things are expanding, earnings are decent, S&P's at an all-time high. You're starting to see, allocations into commodity investments. You start to see capital flow into these other areas of the market. It doesn't reflect a slowdown, right? I don't think that we would see industrial metals and crude oil and other energy investments do well. And I think you got to look outside of just the commodity here. You look at like XLE as an energy sector ETF or XOP, OIH. You can do the same thing with some of the natural gas companies. But when you look outside and you see all of this starting to do well, you see sectors of the equity market that are outperforming that typically would historically in times of economic expansion. It should be a signal. Mm-hmm. And I think when you look at Bitcoin as a risk asset and knowing that it's typically positively correlated to everything else I'm describing, I think it gives you some degree of confidence that, when you're looking at all-time highs, you're wondering, is this going to continue or are others going to play catch-up? I think we're in a good environment for crypto, and I think we'll remain in that for some time. And if you start to see this all trade a lot differently, then you're going to have to question that assumption. But for now, again, it's like there are real reasons as to why, given what's going on in the economy and kind of some of the strength that we're seeing, why you might want to be long. Not just crypto, but assets in general here.
Right. Money printer go burr.
It seems that way, right? And those interest rate expectations, which you can check out over on the CME's FedWatch tool, I'll give you the probability based on the Fed funds futures of what the market is pricing in terms of the probability of a cut or no change or even a hike in some cases, but we're obviously not in an interest rate hiking cycle. We're in a cutting cycle. But, you can keep an eye on those, and they seem to indicate, well, they can change that, we get 2 more cuts this year in an environment where if, the bottom doesn't fall out here in terms of growth, which it doesn't look like that today, you could see a little bit more fuel on the fire. You could see things go higher. You could see S&P 7,000. I don't think that's out of the question. You could see Bitcoin, arbitrarily probably trade up closer to 150.
Is that your price prediction?
Not a prediction necessarily, but I just think, look, you've taken out this all-time high. Market will kind of test some of these bigger numbers. Who really wants to sit in front of this, right? There will be pullbacks at time, and I don't know, maybe it gets up to name your arbitrary price and pulls back to 100,000 or whatever it might be. There's going to be great trades to be had on both sides, and there have been, even if you look at the past few months, if you were able to time a short in there and cover it, you've had some decent ranges that you've been able to trade. But I think if you just look at, okay, arbitrarily, we like these big round numbers, probably make a move towards 150. That's what I would be looking for, right? Doesn't mean it gets there, but how does it trade up into that if it does go there? Maybe it pulls back from here, but we've got to watch the price.
Love that.
And I think the other thing that you want to look at too is whether or not you have an expansion in implied volatility. We know that there's typically a positive correlation between volatility and price, meaning that as price moves higher, volatility expands. That's usually the opposite in the equity market, as everybody knows. When prices go down, volatility goes up. Things are a lot more volatile to the downside. Take the stairs up, elevator down, that sort of thing. It's the opposite in crypto. Take the elevator up or the rocket in some cases. And so if you see that expanding or expansion in volatility and prices move higher, I think that's a positive signal, but again, something to keep an eye on. Mm-hmm. So outside of, and let's jump to our performance dashboard here, Shelly.
Green on the screen.
A lot of green on the screen. I've got Bitcoin at 124.9, so right around where we were at 10:30 this morning. So these are the slides that we used on Options Trading Concepts Live. ETH is, right about the same price, 46.80. So pulled back from where we were just about an hour ago. I think ETH's about $100 lower, but pretty positive price momentum here, slightly higher levels of volatility from where we were at, a week ago or so. But outside of Bitcoin, outside of ETH, Solana, relative underperformer here year to date. So the way that I would read this is Bitcoin's up 34% year to date. ETH against that is up 6%. So at the time, ETH up 40% year to date. Solana down versus Bitcoin. So still on its own up, positive territory year to date, but less than 34%.
Interesting. Okay.
25% if my math's correct. Putting it down versus Bitcoin, 9%. But what else are you focused on? You mentioned some of the stuff in your your trenches bag, some of the AI agents that you're trading, any other areas of the market that you've got your eye on? Or are you just riding off into the sunset after this this punks call? Okay.
Not quite yet. Although punk strategy is fascinating. I love what that's doing for just overall the industry. Like Web3, NFTs, just the community. It's breathing a lot of fresh air into some sleeping giants, if you will. And I see Gary mentioning the TC token. Dan's out of town this week, so we're not doing anything with TC this week, but next week we will be. And I just got off of a very exciting call that I can't talk about. So I was like, can't say anything, but there's going to be some cool stuff coming to TC. So yeah, otherwise, I'm trying to think what other tokens I've been playing with. Really just looking at those virtuals, AI agents.
Well, can I ask you this? You don't have to tell us size, of course, but what is your biggest position?
Biggest position?
Yeah, what's your biggest bet here? Where do you have the most conviction around that you put, put your money where your mouth is?
Hyperfi.
Hyperfi, okay.
Yep.
Not Hyperliquid, Hyperfi.
Yeah,
Two separate
Hyperfi.
things.
Very, very different. I've been in Hyperfi for years, but they only launched the token last year, and I still hold a very big bag and bought more.
Okay.
So, yeah, they're
Correct
doing.
me if I'm wrong, but that's a metaverse play in a sense, right?
Yeah, but it's so much bigger than that because it's almost like they took the on-chain component kind of out of it, and it's more about 3D websites. Like if you have a server, you can launch your own 3D website using AI. It's like prompting 3D building, which is revolutionary to that space.
Yeah, that's huge versus having to know how to code all of that yourself.
Code and render in 3D modeling. Like you can just say, prompt, build me a carousel, and it will be a working 3D model in a virtual space. So if you want a 3D website, fully immersive, like jump in, walk around your website. I mean, it's huge.
It's cool. Yeah.
It's so cool.
I mean, my argument is probably, in my opinion, that not Hyperfi necessarily, but when I look at the whole space, it's still early.
Oh, yeah.
I think that's the direction it's going in, The metaverse, really, what is that? I think a lot of times people think of that as like a game. You're inside of it. It's completely immersive virtual world, which if you have the VR headset and that's how you experience websites, you're at the store, you're able to try on the clothes, you see what you look like digitally versus going to the brick and mortar store. I think there's going to definitely be more of these experiences. It's probably hard to, I'm just making up something, but it's hard to pin it down. But I think that's the direction that it's going in, right?
Oh, yeah. And see, with Hyperfi, they really, and I should just say it's one guy building this, incredible tool. It's like the WordPress for 3D building.
Okay, that's a great way to describe it.
And so, but he, excuse me, I don't know what's going on with my throat. He's making it so that anybody can do this, plug and play. It's mobile friendly, VR friendly, and desktop, whatever. It's all device friendly. So you don't get stuck in I need some clunky VR headset. This is no, you can run around on your phone.
Go in your browser.
Yeah.
That's cool.
So it's really accessible. And yeah. Ash Connell.
Okay. That's the guy behind it.
Uh-huh.
Cool. Maybe we'll have him. I don't know if you guys have talked to him on Beans, but maybe we can get him on the show.
Not yet.
Okay.
Definitely want to.
Unless he's elusive. Sometimes these guys are hard to pin
he's
down.
busy.
Yeah.
You don't hear from him, and then all of a sudden it's it's because he created this,
he's grinding.
World-changing thing. Okay. Yeah.
That's awesome. Well, hopefully we can get Ash on the show at some point. Speaking of guests upcoming on the show, Shelly, we've got fan favorite Greg Magadini, of course, coming back on the show on Wednesday. So make sure that you tune in for that. I love having Greg on the show. Always has a really interesting view on markets and, of course, is just spewing trade ideas, really good trade ideas, by the way, left and right. So looking forward to getting Greg's insights.
And speaking of guests,
Wednesday.
You're my guest on Beans this Friday.
Yeah, and I'll be on Beans on Friday. My first time. Looking forward to it. Switch it up a little bit. Awesome. Well, Shelley, thanks for coming on with me here today, talking a little bit about what we're seeing in the macro space, the belief again being that, or the view being that this rally should continue, given kind of what we're seeing elsewhere when we look at kind of macro economic backdrops and kind of price performance in other asset classes. But again, anything can happen. We'll get Greg's views on Wednesday. So looking forward to that. But we'll be back for the show Wednesday. I'll be back with Shelley on Friday. Thank you all for tuning in and joining us in the chat. Shout out to everybody. Again, Lone Sophos popping in late. Better late than never. What's up? Big Deal Donuts. Thank you guys. As always, we'll be back later this week. Until then, I'm Ryan.
Shelley.
Peace.